that, and we've got Dinshaw Irani now to talk about what he's making of the market right now. Dinshaw, hi, good morning. I guess you're the style inspiration now. We had Samir the other day, and he was wearing these funky blue glasses, and we asked him what's with that, and he said, I've got to match up to Dinshaw.
Morning, Aisha. Thank you for having me on your show, and a very good morning to you and your viewers. Actually, you got the brand wrong. So this is a different brand from us. But still, I like his style too.
Can't beat yours. That half-wide frame, no one can match that. But anyway, Dinshaw, what's happening with the market? I mean, how do you read? Or do you just do nothing and wait for all the news flow around, be it West Asia, be it on the tariffs and everything else to just settle down?
So, Aisha, these are distractions, I think. I mean, we've been calling out a flattish market from, I think, beginning of this year. So the whole call was on the fundamentals. And frankly, I mean, if anything, if you look at the December, and our call was based on December quarter numbers, we felt that things weren't looking too good and will trickle into the March quarter, which it did. I mean, the March numbers weren't that exciting either. And then comes the current quarter. If you hear the commentary of the managements, which came out with the numbers for the March quarter, the commentary was pretty downbeat. I mean, April and May both look very downbeat numbers. In fact, yesterday, Voltas had a analyst meet, and they called out a 20 to 30% dip in AC sales, as air conditioning sales as such, which is fairly concerning. But so the fact is that things didn't improve, right? And then came along these conflicts, be it our own geopolitical tensions or with our neighbor, or the recent one, which is Iran and Israel. But as I said, these are distractions. I don't think the market was anyway poised for a rally. The only thing that was supporting the markets was the flows. And frankly, I mean, our feel is still a time correction going forward. We think it's a flattish market, given the fact that nothing's happening on the domestic front. Though, by the way, the silver lining is the way RBI has tackled this whole situation. I mean, it started off with the government giving those huge sops on the tax front. Then came RBI with this bazooka that they came out with, which was 0.5% cut in the interest rates and 1% cut in CRR. I think that's going to have a very good impact, but with a time lag. So maybe, I mean, the call is that probably you'll see the festive season, which is the December quarter, where the real party will begin.
Okay, Dinshaw, hi, morning. This is Snehi also joining in. It's been quite some time of ups and downs for our markets, but also some positives like you were just highlighting. Amid this setup that we have for our markets, which stocks or sectors are you seeing value? Where are you seeing this value emerging?
So basically, the first one off, which is what RBI did, the action that RBI did, that percolates down to the biggest gainers would be the NBFCs. I think that's where the real activity starts, because their lending book is on a short cycle, their borrowing book is on a short cycle, so they can really impact they can really change their NIMs, not impact their NIMs at all as such. Coming to the private sector banks, again, there's probably a quarter or two before the real impact comes in. Fortunately, the CRR cuts will have a healthy impact, and that will be probably after a quarter or so. So that will hit them. PSUs are definitely losers out here. The PSU banks, that is, are definitely losers out here, given the fact that their lending book is on a long cycle, their borrowing book is on a short cycle. So their NIMs will definitely get impacted totally. And plus their MTMs, mark-to-market book, which will get impacted straight away. So I think that's where the concern lies. Otherwise, the BFSI space looks pretty healthy going forward. That's the one area that we are very gung-ho about. The second one, which is in healthcare, which is mainly the hospital segment, I think that's going to do phenomenally well. Tourism, again, with a lag, it'll catch up, given that the per capita are going to go up. And obviously our new age companies. I think that's where we've really focused on the NBFC space and the new age companies, where we increase our exposure going forward, because I think this is what India has to offer. And I think that's where the real growth will be.
Absolutely. Dinshaw, just picking up on the financials, and we've been wondering that as well, because what started off with love for select private banks, it seems like now you've got to broaden that pool. I mean, there's, of course, NBFCs led by Bajaj Finance, which have done really well, but the smaller ones as well post policy, because now that you've got regulatory backing, if I can call it that, for the financial sector. And also insurance, that's picking up very smartly, and things are really turning the corner for that sector too.
Yeah, Asha, actually you're right, because I mean, if you see our portfolio, the June portfolio which will come out, you'll see quite a few small cap and mid cap NBFCs which have made it into our portfolio. And frankly, I mean, even the gold lenders for that matter. You saw that the RBI, the earlier announcement, I mean, not policy announcement, the paper that they came out with, the policy which came out was much more diluted than the consultation paper that they came out with. So that helped this thing, and the gold lenders. And obviously insurance space has been fairly good for us. I mean, we've been stocking up, but mainly on the life insurance part. The general insurance we've not been that gung-ho about. But life insurance we've been fairly bullish on. And by the way, one more thing that you forgot in the BFSI space, I think the money managers, be it the AMCs or the wealth managers, I think they're doing good. They're going to do fairly well with this kind of liquidity coming in and the deposit rates going down. The only other revenue is probably mutual funds, equities, and so on and so forth. So I think that's where the growth will come through.
Okay, and Dinshaw, healthcare is something that you spoke about, and that is a theme that we're hearing a lot of experts recommend right now. It's slowly seeping through on the positive radar of a lot of market experts within the healthcare theme. Would it be diagnostics? Would it be hospitals? Within this theme, what subsectors would you be placing your bets on?
So basically, it will be mainly the hospital sector, mainly because the fact that once your insurance policies pick up, there's a trickle-down effect, right? I mean, the whole area about healthcare is that the insurance penetration is fairly low. Once that picks up, people don't mind spending on healthcare because it's already covered, and that's where the quality rooms, not rooms, are the quality healthcare. Which is fairly, there's a lot of paucity of that quality rooms availability in hospital sector. So I think that's where the growth comes from. And frankly, I mean, we've seen that, right? The average revenues per bed is moving up regularly. And especially in the cases where the hospitals have expanded capacities, the break-evens have come down quite sharply. I mean, break-even time rather has come down quite sharply, mainly because of this reason, right? So that's where the comfort comes from, and that's why we are fairly bullish on the hospital sector.
Then, so what happens to that erstwhile urban consumption, that entire K-shaped recovery that we came out of COVID with? You think that's eased off somewhat?
So it did, Aisha, because of the kind of action that RBI took, and rightly so, because RBI was very concerned about inflation, and they started taking their foot off the pedal in the sense that they were sucking out liquidity from the system by either selling dollars or coming down on the bank lending space, rather the unsecured lending space and stuff like that. So that compressed the consumer durable sector, because that's where the consumer really takes loans to buy those. That's where the Bajaj Finance and the HDFC banks come in, right? So that's why I think that impacted that. But with the new governor coming in, I think he realized that demand is taking a hit. Inflation was anyway benign by the time he took charge. And I think that's where the new governor took a call that, look, I need to infuse liquidity. And that's what he started with. Actually, in a long time, I haven't seen our bank buying dollars and throwing in rupees in the system. And that's what first step he took. So I think that's where the comfort comes in. But one more thing one has to guard against, and by the way, as I said, that this liquidity infusion, which probably started some 4 or 5 months back in an earnest pace by the RBI, it'll take a couple of quarters before it trickles down to the consumer per se and starts impacting him in the sense that he starts getting the comfort coming in as such. So I think that's where the thing stands today. And frankly, I mean, as I said, that even the ACs, by the way, till last quarter, it was only the heat-related products like air conditioning and fans and all, which were helping out the consumer space. But even that has taken a tank thanks to the good monsoons and the early onset of monsoons and stuff like that. So the summers were fairly compressed, so that got impacted. So I think that space today will probably wait for a while before it takes off. Otherwise, we're not too comfortable right now.
So have you downsized your existing positions in any of the consumption names?
Aisha, we didn't have any big consumer durable with us. We had, as I said,
not consumer durable. I'm talking about the larger consumption pool, your Vedant Fashions et al.
Oh, those he moved out of long back. We didn't, in fact, I think maybe a year or so back, we moved out of those names as such. We did cut off quite a bit. I mean, not only that, there were Campus also, which was there with us, which we took away from the table. I mean, we called it out much earlier, I suppose, and we moved out of those names. So we don't have any those kind of consumer names are discreet. We called it as affordable luxury. I think we moved out of those space fairly long back.
Yeah, I guess it's quite reflective in the stock price as well. But Dinshaw, tell me, where is it that in the last 3 months, if at all, have you added positions anywhere?
So Aisha, as I said, that probably BFSI was the space where we added our positions in. The new age companies, and by the way, in the BFSI was mainly private sector and the NBFCs, insurance, wealth managers, all these spaces we've been adding to our positions per se. The new age companies, they saw a lot of correction in between, and that's where we added our exposure to. There were a couple of, I won't say couple, there was probably one power company that we added to our portfolio as such, not power company, but it was a equipment supplier to power. It's one of the technology leaders in the world, and that's what we added to our portfolio. So these are the few names that we've been adding to on a regular basis. Obviously, tourism, which is hotels, and aviation is another sector that we added to, and hospitals has been our baby all along.
So these are some sectors that you're liking, but given in light of the current market consolidation that we're seeing, which are some sectors or spaces in the market that are still looking expensive in terms of valuations and that you would be avoiding right now?
So for some reason, I don't know. I mean, IT has been hanging on for a while. I mean, it's one of the sectors which just flummoxed us. We've been negative on IT. We turned negative from Feb onwards, basically after NESCOM. We turned quite negative on IT. And frankly, I mean, that sector doesn't seem to be having much upside going forward, because the call is, one, the biggest market is US. US is going through a fairly uncertain phase today, and that's seeing a lot of choppiness. And obviously AI, which we all along thought will assist IT, has turned out to be a big dampener for IT. I think it's a big disruptor for IT, because the three-part equation that our IT industry was surviving on the last 30 years, which is mainly the number of people into the number of hours into the rate per hour. The two parts of that equation have been questioned because of AI, which is number of people and the number of hours spent by these people. So I don't know how much rate you can compensate those two parts of the equation. So that is where the problem lies, and that's why we are away from IT. That's one sector. The other one is obviously FMCG. We're not seeing much upside. In fact, this was the first time I've heard Unilever, the leader in that space, say that he's been giving credit to his distributors, and he's taking a margin hit and stuff like that. I've never heard Unilever talking like that. So obviously, there's a lot of competition building in. The valuations are at peak levels. So these are a few sectors where we're not that comfortable.
Okay, Dinshaw, so good to chat with you today, and thanks for accommodating this very last-minute request.
Always a pleasure, Aisha.
Thanks. Okay.